Okay. Good morning, everyone. Good morning, Manini. Good morning, students. Welcome back to our second session on Ind AS 33. So in the previous class, we discussed what is earnings per share. We discussed how to calculate weighted average number of equity shares. We saw a couple of examples. Then we moved on to what we understand by basic EPS and how to calculate. Then we looked at certain cases of bonus where we will have to restate the current period as well as the previous period's EPS to ensure they are comparable. Then we also saw the rights issue and how there is a bonus component that is present in the rights issue and how to do the adjustment. We saw both the methods, rights containing a bonus as well as the use of something known as a rights adjustment factor. So with this, we had ended the previous session, and just before the closure, I think we had discussed the numerator part. The denominator was weighted average number. The numerator is your net profit attributable to equity shareholders. So we had discussed the issue surrounding preference dividend. Okay. So preference shares classified as financial liabilities, the dividend would actually be nothing but the finance cost based on the effective interest rate. So that would already be deducted while I determine my net profit before tax. So no further adjustment was required. If it was to be classified as equity, for example, irredeemable preference shares with discretionary dividends, okay, it's not a reality under Companies Act 2013, but under Ind AS it's definitely possible. So it bears the features of equity. So at that point of time, preference dividend would be an appropriation which will be deducted separately to determine net profit for equity shareholders. Okay. Then we also saw cumulative and non-cumulative preference shares. Cumulative, every year dividend accrues, so it will be deducted irrespective of declared or not. Okay. Then we move to non-cumulative. It will be deducted only if declared or paid during the relevant year under question. Okay. Then we saw premium or discount on early settlement. So if there is early redemption, it would have been adjusted in retained earnings. So therefore a separate adjustment is needed. If it is early conversion, it would be regarded as finance cost. Since the expense is already considered in net profit after tax, no further adjustment is required. This is based on what the Institute study mat has solved. Okay. Although we will actually have to look at whether the preference share is a financial liability or an equity in the first place. Okay. Any other payment which would be deductible from P&L, which would which would be deductible from P&L and also from securities premium. So for example, premium on redemption, expenses towards issue, etc., etc. So these are the matters that which would be ordinarily deductible, but also deductible from securities premium, etc. These are also going to be considered as my deductions from P&L if it has not happened previously. Okay, so this we had stopped at this stage, and then we would be continuing with some questions, some problems, and then coming back to diluted EPS discussions today. Is it okay whatever we have done in the previous class? Are you guys okay with it? Good morning, Soham. Good morning, Srishti. Where are the others? I hope you are there. Okay. So let us start. Kind of able to recollect? Yes. So let us start our discussion. Slide. Okay. All right. Okay, fine. Good morning, Sandhya Gauri. Yes. So let us start. We pick up the questions today relating to that early conversion, early redemption. Okay, because that was the last part which we had just ended with theory. So let us come to the illustrations from your module. ABC Limited issues 9% preference shares of fair value rupees 10 each. Okay, on 1420x1. Total value of the issue is rupees 10 lakhs. The shares are issued for a period of 5 years and would be redeemed at the end of the 5th year. The shares are to be redeemed at rupees 11 each. At the end of year 3, that is on 31st March 20x4, the company finds that it has earned good returns than expected over the last 3 years, okay, and can make the redemption of preference shares early. So this is a case of early redemption. Acha, in the case of early redemption, you would be required to pay a premium because your shareholders have invested the money in you, depending on the fact that they would be earning incomes over the next couple of years. You are redeeming earlier than what is the contracted agreement. So you will be required to compensate them. You will be required to compensate them. Okay. So to compensate the shareholders for 2 years of dividend, which they need to forego, the company decided to redeem the shares at rupees 12 each instead of the original agreement of rupees 11. Comment on the impact of early conversion of preference shares at a premium on earnings for the year X3, X4 attributable to ordinary equity holders of ABC Limited for basic EPS. Ignore the effective interest rate impact in the solution and answer only on the basis of Ind AS 33. So how many equity shares am I having? Well, I am having 1 lakh. 1 lakh preference shares. Okay. How did I get 1 lakh? Well, simple. 10 lakh tha divided by rupees 10. So that comes to how much? 1 lakh preference shares. Okay. And for these 1 lakh preference shares, you are going to make the conversion early. You are going to, kya kaha? Nahi, not conversion, redemption. You are going to make the redemption earlier than what is the stipulated period. For that, you are going to pay them 12 instead of 11. Matlab 1 rupee per share extra. So that becomes your premium into rupees 12 minus rupees 11. Okay. So that gives you rupees 1 lakh. That gives you rupees 1 lakh, which will be deducted to arrive at your net profit attributable to equity shareholders. Okay, 1 lakh deductible from net profit after tax to determine net profit attributable to equity shareholders. Acha, originally where would this amount go? Originally this would have gone in other equity. Typically we use securities premium. So that is what we had written in our notes. Okay. Early redemption would have been adjusted in retained earnings. Okay. That means securities premium, reserves, etc. वो P&L में नहीं गया रहेगा. That is why now to arrive at net profit attributable to equity shareholders, we would have to deduct this. Is it okay? Have you guys understood this? It's quite simple, nothing special, nothing difficult. Okay, it's plain understanding. Is it okay? Have you guys understood? Yes. All right, fine. So we then move on to the next part. That is the next illustration surrounding these concepts only. Okay. So an entity has the following preference shares in issue at the end of 20x4. 5% redeemable non-cumulative preference shares. Redeemable non-cumulative preference shares. These shares are classified as liabilities. These shares are classified as liabilities. During the year, a dividend was paid on the 5% preference shares amounting to rupees 1 lakh. Now you tell me, it is already classified as what? It is already classified as a liability. So what is the required part? Let us just see. The profit after tax for the year is 1,50,000. Determine the adjustments for the purpose of calculating EPS. So basically we have to find out net profit attributable to equity shareholders. Okay. So therefore we start off with something like this. PAT 1,50,000. PAT 1,50,000. Okay, next one. 5% redeemable non-cumulative preference shares. These are recognized as liabilities. During the year, a dividend was paid of rupees 1 lakh. So now I want you to tell me, should I make an adjustment for this 1 lakh rupees or should I ignore it? If I have to ignore, tell me why I should ignore. You can have a look at the charts that we had prepared in the last class. Okay. Soham has already given me one answer. Others? Manini also has given the same answer. Yes, Kaushiki is not to be seen. Srishti, where are the others? Hari, Aniket Jain, Sumit Jain. Shailendra has answered. Manini has also answered. And it's right. Okay. So essentially it is classified as liabilities. That means finance cost recorded in P&L. Hence, ignore. In the PAT of rupees 1,50,000, this adjustment is already recorded and therefore we will not be doing anything. Okay, it is classified as a liability. Okay, it is classified as a liability. I understand that you have not studied financial instruments. Doesn't matter. Very simple. If anything is recognized as a liability, they've already given it to you. Any liability, financial liability, will have an interest component, and interest component means finance cost. Finance cost means it is in your profit and loss. So therefore there won't be any adjustment for the dividends which are paid. Okay, you will get more clarity when we do financial instruments, but wherever it is there, I will try to explain to you. Okay, we have 1 or 2 questions with financial instruments applications, so we will look at those. Okay, so Srishti, I hope you understood. Sandhya Gauri is right. Rashmi Kamath is right. Okay, all right. Let us move on to the next one. Increasing rate, cumulative, non-redeemable preference shares issued at a discount with a cumulative dividend rate from 20x5 of 10%. Okay, so what is happening is, if I have to draw a timeline, initially I don't have dividends. Okay, this is time. This is dividends. Initially no dividends, and then suddenly my dividends start to increase. These are known as increasing rate preference shares. These are known as increasing rate preference shares. Sir, why do these instruments come? See, typically when you are new into the business, you cannot be expected to make payments towards dividends. So therefore, initially you will say, bhai, I'll not be able to pay you. Once the business is stabilized, cash flows are there, I will pay you a higher rate of dividends. So that is what the shareholders have agreed to, and therefore these are known as increasing rate preference shares. Okay, the shares were issued at a discount to compensate the holders naturally. So 5 साल तक कुछ भी नहीं है ना, 20x0 the dividends, the shares were issued, x5 तक no dividend. So 5 साल तक it is a drought for the shareholders. Matlab, there is no akal pada, sukha pada. There is nothing which is there for the shareholders to earn. So they say, bhai, तू डिविडेंड 5 साल बाद दे दे, अभी तो मुझे डिस्काउंट दे दे, एटलीस्ट गिव मी अ डिस्काउंट राइट नाउ, यू कैन गिव योर डिविडेंड्स एनी पॉइंट ऑफ टाइम. सो टुडे आई गिव इट एट अ डिस्काउंट, tomorrow I get a higher rate of preference dividend. Okay, the shares were issued at a discount to compensate the holders because dividend payments will not commence until 20x5. The accrual for the discount in the current year, calculated using a effective interest method, amounted to rupees 18,000. Okay, that figure they have only given. These shares are classified as equity, rupees 2 lakhs. These shares are classified as equity, rupees 2 lakhs. Okay, first of all, tell me what adjustment should be done. If no adjustment should be done, why? If adjustment should be done, what is the amount of adjustment? Okay. Kaushiki is nowhere to be seen today. $18,000, I got an answer. 18,000 already adjusted. 2 lakhs to be deducted from net profit after tax. Manini is saying to be added in profit. Any other answers? Adjustment of interest. Okay. Any other answers? Rashmi, Shailendra, Sumit, Aniket also not around. Adjustment of interest. Okay, fine. Let us understand. First of all, these shares are classified as equity. They have given to you. Okay, they have given to you that these shares are classified as equity. So therefore, will there be any finance cost? No, strictly speaking, there will not be any finance cost. So therefore, in this adjustment, if there is any discount or whatever is there, that is not considered in the profit after tax. That is not considered in the profit after tax. Why? Because these instruments are classified as equity, and equity means there will not be a finance cost, and since there is no finance cost, the PAT does not contain the adjustment of this discount. Okay, so that is the first point. Now what is happening is, today I have issued shares at a discount. Why did I issue shares at a discount? Well, I issued shares at a discount because I'm not going to get dividends for the next 5 years. So since you issued shares at a discount, where will I take that discount? Can I take it to my P&L? Answer is no, you cannot. You will have to adjust it in your other equity, in your securities premium or some such accounts. Okay, so that discount will be met from components of other equity which is there in your balance sheet. That means the discount is not coming and hitting the P&L. The discount is not coming and hitting the P&L. But tell me, for the ordinary shareholder, his return is ultimately reduced by this discount because he's going to get less. Are yes or no? Discount आपने किसको दिया? Sir, discount you gave it to this increasing rate non-redeemable preference shares. Because you gave them a discount, the money that came in the company is lower by the discount amount. And since the money that came in is lower by the discount amount, can I say that ultimately the persons who bear the brunt of this discount is the equity shareholder? And therefore, we will have to make an adjustment for this discount. Okay. Now, many of you are giving me answers that discount needs to be adjusted, which is absolutely right. But probably the wordings of the question are making you confused in that some are saying 18,000, some are saying 200,000. Okay. So what do I interpret? Well, the increasing rate preference shares have a value of 2 lakhs. So 2 lakhs is the value of equity shares, and therefore 2 lakhs will not be deducted. 2 lakhs will not be deducted. This is the preference share capital. This is the preference share capital. What will be deducted is the accrual of discount in the current year. That is to say rupees 18,000. So you will be deducting 18,000 discount. Why? Because this discount would have gone in retained earnings or components of equity, and it would not be reflected in the profit, and therefore we have to bring in the profit, because ultimately this money is taken from the share of the equity shareholder. So less discount amortization, 18,000. Discount amortization 18,000. Have you understood? Yes. Have you understood this part? 2 lakhs is preference share capital, not dividends or interest. So therefore we cannot deduct 2 lakhs. Have you understood? Yes. Okay, fine. So Manini got. Soham, did you follow? Srishti, did you follow? Srishti had given the answer. Rashmi Kamath, did you understand? Shailendra? Okay, fine. All right. See, again, this question is typically based. See, the MCA also has the text of these standards. Okay, the MCA has the text of these standards. You can log into MC, you can open MCA and view these standards. So in the MCA standards, you are having certain illustratives. You are having certain illustratives. About 9 to 10 illustratives are there. The problems are there. In fact, many of those problems is incorporated already in your study mat, Acha, there is one small, what I can say, I'll not call it as an error, but there is some problem with the way they have worded the particular standard, with the way they have worded the illustratives, and that impact has flown in this particular illustration as well. See, financial liability is having a deep relation with terms like discount rate, present value, market rate, etc. It is financial liability which has a relationship with discount rate, effective interest rate, all these terms, present value, market rate, all these words which you hear, these are associated with financial liabilities, not with equity. But the standard and the illustratives, both of them are having the terms effective interest method for equity, which is not appropriate in line with financial instruments chapter. Okay, so that is the only what I can say, not mistake, but absence of an appropriate word which is creating this confusion. So if anybody looks at this problem, they will see that on one hand you are saying equity, On the other hand, you are saying discount is calculated using the effective interest method. भाई तो फिर ये गड़बड़ कैसा? How can this happen? If it is equity, there cannot be effective interest method. If there is effective interest method, it should be a financial liability, not an equity. And therefore, this is going to be a slight pain point in the sense that this is not consistent with what are the terms used in Ind AS 109 relating to financial instruments. Ideally, it cannot be effective interest rate for equity, but since we have to take it as a discount and use the words, it is only in this case that we find effective interest rate used for equity. Otherwise, kabhi nahi milega aapko. You'll never find this. Okay. So that takes care of the second adjustment. Moving on to the third. 8% non-redeemable, non-cumulative preference shares. Non-redeemable, non-cumulative. At the beginning of the year, the entity had rupees 1 lakh 8% preference shares outstanding, but at 30th June 20x4, at 30th June 20x4, it repurchased 50% of 50,000 of these at a discount of rupees 1,000. 50,000. Okay, so now come on, tell me. This is something which you would be knowing. Okay. This is something which you would be knowing. Okay. So there is what we call somewhat similar to yes, what you can say, early redemption. This is somewhat similar to early redemption. Okay. Now I have purchased this. I have purchased this at a discount of 50,000. मतलब मैंने कितने का खरीदा? I have purchased preference shares worth 50,000, but for this I have paid only 49,000. For this I have paid only 49,000. So this discount of 1,000 is already credited to equity. Is already credited to equity. It goes and sits in your equity. Sir, what does it mean? Well, the entry that would be passed is bank account debit. The entry that would be passed is preference share capital debit 50,000. 50,000 to bank 49,000. So this 1,000 would be a gain. Would be a gain. Is it okay? Where is this gain going to be recorded? In retained earnings. This will be recorded in retained earnings and not in P&L. Okay. So therefore, is it representing a gain? Yes. And who will be ultimate beneficiaries of this gain? Sir, ultimate beneficiaries will be the equity shareholders. So add it to your net profit. Add gain on early repurchase. So that is 1,000. That is 1,000. Okay. So that is done. Next 7% cumulative convertible preference shares. Cumulative convertible preference shares converted in the current year. Converted in the current year. Yes. These shares were classified as equity until their conversion into ordinary shares at the beginning of the year. No dividend was accrued in respect of the year. Although the previous year's dividend was paid, it's already paid immediately prior to conversion. To induce conversion, the terms of conversion of the 7% convertible preference shares were also amended, and the revised terms entitled the preference shareholders to an additional 100 ordinary shares on conversion with a fair value of rupees 300. So that is nil. The profit after tax for the year 20x4 is 1,50,000. Determine the adjustments. Okay, so most of you gave the right answer to the previous one. So now I want you to think for the last one. I want you to think for the last one. You can look at the chart for early redemption and early conversion, and there you will get the answer. Okay. Come on. Socho. Look at the chart and tell me. Okay, so Soham and Manini have given the answer. What about the others? Srishti, Shailendra, and then the others. Conversion into equity shares, no impact. Okay. Okay, Saksham. All right, fine. So let us understand what is happening. I had certain cumulative convertible preference shares. What were these shares? These are convertible, so they were classified as equity, not as a financial liability. Now, what you have done is, prior to conversion, you have paid off the dividend, so dividend liability is not there. Now, to ensure that they are willing to convert, you are changing the terms of conversion. You are changing the terms of conversion for each, for all the total preference shares. What are you going to give is additional 100 ordinary shares with a fair value of 300. Acha, was this decided earlier? No. This was decided now. ये अभी decide किया हमने to induce conversion. मतलब conversion करे शेयर होल्डर्स, हमारे प्रेफरेंस शेयर होल्डर्स, तो उसको बढ़ावा देने के लिए हमने क्या किया? हमने टर्म्स चेंज किया. क्या है मेरा रिवाइज टर्म्स? भाई हम आपको 100 शेयर और देंगे जिसका फेयर वैल्यू 300 है. यस, सो दिस इज द inducement which is given. This is the inducement which is given. And अगर आप हमारा notes देखोगे, if you look at our notes, early conversion is regarded as a finance cost in the statement of P&L. That means ये जो 300 रुपया है, this is already gone in my statement of P&L as finance cost. Okay, so since the adjustment is already, since the expense is already considered, no further adjustment is required. Okay, so no adjustment. No adjustment. No adjustment. Okay, so that is all that you are having your adjustments. 1,50,000 minus 18 plus 1. So that gives you 1,33,000, if I am not wrong. 1,33,000. What is this? Net profit attributable to equity shareholders. Saksham, did you follow? Shailendra, Manini, Soham, Srishti, did you guys follow? Yes. Yes, NPAES is 1,33,000. That's right. Okay. ठीक है, तो ये हो गया हमारा illustration 2. Okay, again, there is a small inconsistency here, but I mean, we can ignore that. Okay. See, ideally, as I was telling the other day also, that whether you pay a premium on redemption on conversion, you will have to look at what the original instrument was classified as. You will have to discuss what the original instrument was classified as. If the original instrument was a financial liability, whether you convert or not, forget that. The premium will go to finance cost on early redemption or conversion both. If it is classified as equity, the premium on redemption will go under other equity. That's it. So that was how it was. All right. So in this case, we have done based on what the study mat guidance is there. So we stick to that. Okay, we stick to that and answer in that manner. Okay. All right. Can you explain the 18,000 adjustment again? Okay. All right. See, I have invested an amount. I have invested a particular amount. Okay. That particular amount, one second. What I'll do is, I'll explain to you with the help of another example. Okay. So then you should be in a position to understand. Okay. Once we understand this, then I can relate it with 18,000. Okay. A company issued non-convertible, non-redeemable Class A preference shares of rupees 100 par value at the beginning of year 1. These shares are entitled to an annual dividend of 7 per share starting in year 4 at the time of issue. Yani year 1 to year 4, no outflow. No outflow, which is okay. These shares are entitled to a cumulative annual dividend of 7 per share starting in year 4. At the time of issue, the market rate dividend yield on such shares was 7% per year. That means today when I have invested, I expect a 7% dividend on my amount invested. Tomorrow also I expect 7%. Day after also I expect 7%. So compute the following: issue price for preference shares, treatment for computation of EPS. So let us work this out. Okay. So first one is issue price. Issue price. Okay. So what is your issue price? Present value of rupees 100. 3 years I am foregoing my dividend. In these 3 years, the corresponding earning that would be possible is 7%. The corresponding earning would be 7%. मैंने उसको forego कर दिया. And therefore, present value of 100 discounted at 7% for 3 years is 81.63. यानी 100 का शेयर आपको 81.6 रुपीस में मिल रहा है. In our question, this discount of 18.37, this is nothing but the 18,000 rupees which you see. This is nothing but the 18,000 rupees which you see. Okay. Treatment under Ind AS 33. What are you going to do is you will be taking the periods, the carrying amount of preference shares at the beginning of the year, imputed dividend. This is already factored in your price. Carrying amount before dividend of shares at the year end. And finally, that gives you the dividend paid. Okay. So 81.63 into 5.71 is equal to 87.34. 87.34 into 7% gives you 93.46. Into 7% gives you 100. So every year I went on increasing the discount until I reached the value that is required. Have you understood? Yes. Did you understand, Soham? So in our example, 18,000 would be amortized in this particular manner. 18,000 would be capitalized in this particular manner. Did you understand? Yes. Have you guys understood? Yes, so 18,000 I go on writing back. Okay, so therefore that is the adjustment which we have done in our question. Have you understood? Soham, did you follow? Others, any doubts with that 18,000? Yes, that 18,000 will be, that 18,000 will typically not be a finance cost. This 18,000 typically will not be a finance cost because these shares are classified as equity. And in the case of equity, I'll not have a finance cost. That is why this discount amortization is deducted separately. Okay. There is a borrowed concept of discount rate from financial instruments, and there is another concept which is borrowed, that you will have to take it to the what you can say, you will have to not take it as a finance cost since it is recognized as an equity. Did you understand? Yes. It will be shown in the P&L as expenses. That's it. Okay, it will be shown in the P&L as expenses. Typically, I would hesitate to show under finance cost because it is classified as equity. Because it is classified as equity. Because the moment you look at the P&L, you see finance cost. You look in the balance sheet, there is no financial liability. That anomaly I cannot have in my financials. So I'll show it under some expense head. Okay. All right. Fine. तो ये हो गया मेरा illustration 2. These illustrations, frankly speaking, are more confusing. They confuse you more than they clarify your thoughts. Okay, this illustration 1 and illustration 2 वो ज्यादा confusing है, but ठीक है, अभी है तो है, क्या कर सकते हैं. Okay, so we have done now basic EPS, we have done early conversion, early redemption. हमने all these things cover किया है. We then move on to the next part, that is diluted EPS. Diluted EPS. Okay. What do we do with diluted EPS? What do we do with diluted EPS? What is diluted EPS in the first case? Everybody has studied diluted EPS. Okay. नहीं तो final में कैसे पहुंचते, right? AS20 had EPS. In that you had diluted EPS. So tell me, what do you mean by diluted EPS? What do you mean by diluted EPS? Have you heard the term? Yes, come on. Okay, diluted EPS. Shailendra has given one answer. Anybody else? Okay. Okay, fine, fine. Good, 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 good. Okay, so all of you know the concept. Okay, see, my capital structure could be having equity shares plus convertible instruments. For instance, convertible debentures, convertible preference shares, etc. Okay, so what do you mean by diluted EPS? Basic EPS is based on past data. 31st March का EPS you find out after 31st March. Okay, on 31st March मेरा EPS क्या है for the year ending 21-22, आपको वो data मिलेगा, but when are you going to get? After 31st March, not as on 31st March. So this is based on past data, whereas diluted EPS is a forward looking figure. Forward looking figure. Sir, why do you call it as a forward looking figure? Because it takes into account all potential conversion. It takes into account all potential conversions of convertibles. Not only that, considers impact on all forward looking figure, all potential conversion, considers impact on all earnings of the entity on account of conversion. On account of conversion. What does it mean? Suppose you convert. Yours is a debenture, for example. Okay. So debenture means there would be an interest liability. So interest liability to theek hai. Interest liability is fine. Now this interest liability is going to be considered for the purposes of calculating your diluted EPS. For the purposes of calculating your diluted EPS. Okay. And this is actual conversion? No, it is just potential conversion. It is just potential conversion. Acha, when do I assume? Sir, ultimately batao, hame veins nikalna hai. I have to calculate weighted average number of equity shares. For weighted average number, I need to know from which date I have to consider the potential instruments. Well, you will consider the potential instruments at the beginning of the earliest reported period. That is, as if these shares were already in existence, you will take it from that. Or if that is not the case, then at the date of issue, okay, whichever is earlier, whichever is later. Okay. So for example, I'm having 12% preference shares convertible in issue. You are having 12% preference shares convertible in issue from prior periods. Okay, मतलब कई सालों से this 12% convertible preference shares are in issue, and therefore what you can do is you can treat it as potential shares right from prior period. Right from prior period. Suppose in the current period, I have 15% convertible debentures, 15% convertible debentures, and these 15% convertible debentures issued in December 2021. So for the year FY 21-22, the potential shares is going to be only for the period starting from December and ending in March. You cannot say that these instruments are there for the entire period. No. Jab original instrument took birth, at that point of time only the convertible option also took birth. and therefore they will move hand in hand. They will move hand in hand. Did you understand weighted average number, the period which we have to consider? Yes. Did you understand the period? Yes. So it will be later of earliest reporting period or the date of issue. Okay, so that is as simple as it can get. Okay. Ultimately, the impact should be negative. The impact should be negative. Dilute means what? Basic EPS should always be greater than diluted EPS. Basic EPS should always be greater than diluted EPS. Always. Always. Okay. Why? अरे नाम ही देखो, diluted मतलब क्या? Diluted means less concentrated. Less concentrated means it should be lower than the basic EPS figure. अच्छा सर, कभी कभी ज्यादा हो सकता है. Sometimes it will become more. If it becomes more, we call such components as anti-dilutive. We call such components as anti-dilutive, and we will ignore it from EPS working. We will ignore it from EPS working. We will take it from not necessary. सृष्टि, the date of issue can be मैंने 5 साल पहले issue किया था, it's not yet converted. Yes, so जो 5 years पहले है, that becomes your date of issue. Okay, all right. So always, if it is anti-dilutive, if because of your workings if your basic EPS is less than diluted EPS, we call this as anti-dilution. Anti-dilution. Hence, ignore. Hence, ignore. Is it okay? So therefore, in such cases, ignore those shares and then do your EPS calculation with the other shares. Is it okay? Yes. तो ये हो गया मेरा anti-dilution. This is my anti-dilution. You will consider only diluted impacts, not anti-diluted impacts. Yes. All clear? Okay. All right. Fine. So we quickly write a couple of points, okay, for diluted EPS, and then we shall proceed to solve the questions. Otherwise, what we will do is first we'll solve the questions. Leave about 2 pages, and then come to the questions. Okay. Okay, just go through this question. Entity A has in issue 25,000 4% debentures with a nominal value of ₹1. Nominal value means face value. The debentures are convertible to ordinary shares at a rate of 1:1 at any time until 20x9. The management receives a bonus based on 1% of profit before tax. Entity A's results for 20x2 showed a profit before tax of 80,000, profit after tax of 64,000. A tax rate of 20% is assumed. Calculate earnings for the purpose of diluted EPS. खाली numerator ढूंढना है. It's not asking EPS. It's just calling for numerator. Okay. So just read this, try to work it out. Okay, try to work it out. Should not take much time. Okay, don't look at the answers from the study mat. I want you guys to work it out. Okay, just be back in a minute. Yes. Did anybody work out? It's a future looking number based on current data plus certain estimates. Okay. Anybody's worked out? Okay. I got some answers flowing in. Yes. All right. We always start with profit after tax. 64,000. We always start with profit after tax. 64,000. Okay. All right. Now it has 25,000 4% debentures. Okay. With a nominal value of rupee 1. Okay. The tax rate is 20%. So if I convert, what is the first thing that will be saved? The first thing that will be saved is your interest. So add interest, saved. How do I calculate? Sir, 25,000 into 4%. Is this the only thing? No. The moment you save the interest, uske upar tax aayega. You will be having tax on that. What is the tax rate? 20%. So your net benefit is ultimately going to be 1 minus the tax rate. That is, it will be 1 minus 0.2. That is 80% into 1 minus 0.2. Okay. So 0.2 is your tax rate. Okay. So 25,000 into 4%, that is 1,000 into 0.8. So that gives you 800. That gives you 800. Yes. And then let us proceed to check something else. The entity's management receives a bonus based on 1% of profit before tax. 1% of profit before tax. Acha. Before tax, my profit has gone up by 1,000. Yes, sir. And since my profit has gone up by 1,000, can I say that my managerial remuneration will go up by 1% on 1,000? Answer is yes. It will go up by 1% on 1,000. And because the managerial remuneration has gone up by 1% on 1,000, can I say that the tax impact on that increase also will be visible? The tax impact on that increase also will be visible, and therefore we are going to calculate as shown now. This part many students will go wrong. Less increase in MD remuneration. Profit before tax went up by 1,000. Went up by 1,000. Okay. On this 1,000, there is going to be a 1%, what you say, management bonus. There is going to be a 1% management bonus. And with increase in management bonus, tax is going to get impacted. So therefore, the net earnings will be net of tax. Okay, into 1 minus 0.2. So that gives you 1,000 into 1% is 10 into 0.8. That gives you 8. So if you do the add less, 64,792. This becomes net profit attributable to equity shareholder. Are, have you understood? Yes. Adjusted for dilutive impacts. Yes, please explain the last adjustment. Okay. See, interest saved. See, 25,000 into 4%. मेरा total interest कितना बचा sir? My interest saved is 1,000. Okay. Interest saved is 1,000. That means net profit before tax increases by 1,000. Yes, sir. Net profit before tax increases by 1,000. That means bonus increases by 1%. Bonus is equal to 1,000 into 1%. This is the increase. This is the increase. So 1,000 into 1% comes to how much? It comes to 10. It comes to 10. It comes to 10. This is bonus increase. Bonus increase is an expenditure for the company. Okay. But if bonus increases, bonus is a deductible expenditure for tax purposes. Yes. And therefore 10 into 1 minus 0.2. 10 into 1 minus 0.2, that gives you 8. So the net increase in MD remuneration is 8 rupees. Since it has increased, your net profit will come down. And that is why we are deducting 8. Did you follow? Vishal has joined in. Yes. Others, did you follow, guys? Okay, fine. All right. So that takes care of this. So when I calculate my diluted EPS, what is going to be in my denominator? The number of shares for basic EPS plus the potential shares, plus the potential shares. Numerator will be the net profit for basic EPS plus whatever adjustments you want to continue, whatever adjustments you want to continue. Okay, so that takes care of illustration 7. Let us then move on to the next one, that is okay, illustration 8, again from your study module. Okay, this is something known as incremental EPS. Basically, incremental kya hota hai? Because of conversion, what is the increase in my earnings? What is the increase in my shares? So divide both of the incremental things and then you should be in a position to arrive at the incremental EPS. Okay. ABC has 10 lakh rupee 1 ordinary shares and 1,000 rupee 100 10% convertible bonds issued at par, each convertible into 20 ordinary shares on demand, all of which have been in issue for the whole of the reporting period. So there is no potential here. Okay. ABC Limited share price is 4.5 per share. Earnings for the period are rupees 5 lakhs. The tax rate applicable to the entity is 21%. Calculate basic EPS, earnings per incremental share for the convertible bonds and diluted EPS. तो अपने को तीनों ढूंढ निकालना है. We have to find out all the three. Okay. Anybody wants to try basic EPS? 1 minute I'll give you. Basic EPS, 1 minute. I'm writing here only because answer mein, matlab it's not that big an answer. Okay. So basic EPS is 5 lakhs divided by basic EPS rupees 5 lakhs divided by 10 lakh shares. 10 lakh shares. So that comes to 0.5 per share. Excellent. Oh, so hum already calculated all the impacts. Okay. All right. So basic EPS is 0.5. दो लाइन का आंसर भी नहीं है. Okay. Incremental EPS. Because of conversion, what is happening? Sir, because of conversion, my earnings are increasing. My earnings are increasing. Net increase in earnings on conversion divided by number of shares issued on conversion. देखो, the word used is incremental. Okay. So only the differential. Okay. So net increase in earnings कितना है? How much is that? 1000 rupee 100 bond. So that is rupees 1 lakh into 10%. This is the interest cost saved into 1 minus tax rate. 1 minus tax rate divided by number of shares issued on conversion. Number of shares issued on conversion. How many shares would be issued? Each convertible into 20 ordinary shares. So 1000 bonds into 20 shares. So that is equal to 1 lakh into 10%, 10,000. Into 0.21. 1 minus 0.21. So that is 7,900 divided by, what is the number of shares? 1000 into 20. 20,000 shares. So 7,900 divided by 20,000. As many of you have rightly said, 0.395. This is incremental EPS. And now, if I proceed to calculate your diluted EPS. Diluted EPS. How do I calculate the diluted EPS? Well, diluted EPS is nothing but basic EPS का ही data ले लो. Plus rupees 7,900 divided by plus 20,000 shares. So basically जो incremental है, that only we are adding it here. So this comes to 507,900 divided by so 507 . divided by 0.498 per share. 0.498 per share. Yes. So that is right. So 0.497498. Acha, is it actually dilutive? Yes. Original was 0.5. This is 0.498. Okay. So you can take it that the question is concluded. All the required things are done. Yes. Basic dhunda, incremental share dhunda, and diluted EPS also done. Is it understood? Yes. Have you guys understood this illustration 8? Yes. Manini, 4979 क्या है? What is 4979? Okay. All right. You had asked some 4979. I don't know. Aniket Jain, that's right. Okay. All okay. So 0.49. Yeah. So 498. Okay. Fine. All right. तो ये हो गया मेरा illustration 8. ये हो गया मेरा illustration 8. All right. Next one. Next one. We move on to the next one. Okay. Holder of 25,000 bonds. Okay. I want you to work this out. Okay. Important. This is important. 1st January, you had 10 lakh shares. That's right. Okay. You had 10 lakh shares. 5% convertible bonds of rupees 1 lakh, terms of conversion 120 ordinary shares for rupees 100. 31st March, holders of 25,000 bonds converted to ordinary shares. Profits for the year ended 31st December is rupees 2 lakhs. Tax rate is 30%. Calculate basic and diluted EPS. Ignore the need to split the convertible bonds into liability and equity elements. Okay, so forget that. I give you 5 minutes. I give you 5 minutes. Calculate basic EPS and diluted EPS for me without looking at the answer in the study mat. Okay, do not look at the answer in the study material. I want you to try this by yourself. Okay, fine. Saksham has also given. All right. So take 5 minutes, read this, try it out by yourself, punch your answers in. I want you guys to be very careful. This should be holders of rupees 25,000 bonds. Work it out. Okay, basic EPS 0.2. I take it you have rounded off, which is okay. That's right. Move ahead. Okay, Soham has given answers. Srishti has given some answers. एंड थैंकफुली किसी का आंसर किसी के साथ भी नहीं मिल रहा है, सबका अपना अपना आंसर आ रहा है, विच इज गुड. Saksham is right. Yes. Any other answers? Saksham gave me basic EPS. What about the others, Saksham? Shailendra. I'm still waiting for answers. Okay, Aniket Jain has given me one answer. Diluted. Diluted batao. Another 2 minutes and then I shall start. Okay, just continue, please. Okay, all right. So we are getting different answers for diluted. Basic, more or less everybody got it right. So let us start to solve. Okay, all right. So first things first, we are having convertible bonds. All right. What are the terms of conversion? Well, 120 ordinary shares for rupees 100. Okay. So 5% convertible bonds of rupees 1 lakh. Okay. 5% convertible bonds of rupees 1 lakh. Now, some of it is getting converted in the current year. Second. Rupees 25,000 converted on 31st March and rupees 75,000 not converted. Not converted. Okay. So if it is converted, how many shares? Rupees 25,000 divided by 100 into 120 shares. So that comes to 30,000 shares. That comes to 30,000 shares. Not converted. $90,000 shares. 90,000 shares. So if you look at these first set of shares of 25,000 rupees, they are converted from 31st March. That means they are in existence right from 1st April till 31st December. So in other words, actually they are present. Second yaar, isko kya ho gaya? Yeah, actually, one second. Just a minute. Yep. Actually, they are present from 1st April to 31st December. That means, can I say that these shares were potential for the period from 1st of January to 31st March? Can I say this? Of course, I can say this. Yes. Can I say this? Of course, I can say this. Whereas in this case, there is no conversion at all. So actual shares, never. Entirely, it is potential. Entirely, it is potential from 1st of Jan to 31st December. From 1st of Jan to 31st of December. Okay. So therefore, when these instruments get converted, what is the interest impact? Interest is 75,000 into 5%. This is for the full year. So 75,000 into 5%. So this gives you 3,750. Whereas in the case of rupees 25,000, the interest component will be only for a period of 3 months. 25,000 into 5% into 3 by 12. So that gives you 25,000 into 5% into 3 by 12. 312 0.5. This is what is your interest. This is what is your interest. Do I have a tax component? Yes. So tax rate is 30%. So we will do the interest figures net of tax. Basic EPS, you would have taken rupees 2 lakhs divided by 10 lakhs into 12 by 12. This is the existing share capital plus these actual shares for 9-month period. For a 9-month period. So that gives you how much? 30,000. So rupees 2 lakhs divided by 10, 20 to 500 shares. $0.196 per share. So this part, most of you got it right. This part, most of you got it right. I am not going to even ask. Okay. There were some of you who got the diluted EPS also correct, which is good. Okay. Which is impressive. Okay. So now let us start. Diluted EPS starts where basic EPS ends. Hamesha yaad rakho. Diluted EPS starts where basic EPS ends. So therefore, if you have to start with diluted EPS, all that you have to do is your diluted EPS figure will be the starting of basic plus certain incremental adjustments. So what is the incremental adjustment? First one is this interest adjustment of 312.5. 312.5 into 1 minus 0.30. Okay. This is your interest which you are going to save. This is your interest which you are going to save. Is it okay? For the potential, for the period when they were potential equity shares. Plus, here you are going to save 3750 1 minus 0.3. 1 minus 0.3. This whole thing, we already have number of shares for basic. Only thing what you have to consider is the potential shares. 90,000 into 12 by 12. Okay. All right. Fine. Done. So this takes care of the workings. So 2 lakh 3750, 2 lakhs plus 3750. 0.7 plus Always compare it with your basic. Your basic was 0.196. This is 0.181. So this is diluted. This is diluted. Is it okay? Have you guys understood? Okay, so I have some queries. Okay, Soham is asking, sir, 312.5 has already come in actuals. So why to add it? Arey Baba, that is why we are adding it. Because it is potential for the period of 1st Jan to 31st of March. I should not include the finance cost for these 3 months. No, you are telling it is already there in the actual figures of 2 lakhs. Absolutely right. But when I am considering this period as potential for this period, then there would not be any, what you can say, there would not be any finance cost, because now we are assuming that it's converted since it's a potential equity share. So for that potentiality, we are going to take the workings. Okay. How did 11 lakh 20? Just add this, no, 10 lakh into 12 by 12. 30,000 plus 30,000 into, this is not 9 by 12, sorry, this is 3 by 12. This is 3 by 12. Okay, that for the potential shares, you will have to consider it as 1 second. 10 lakh 22,500 plus 30,000 into 3 by 12 plus 90,000 into, okay. All right, fine. I'm just rubbing this off to explain the timelines. Okay. Because there is some confusion there. First January, 31st December, and then I'm having 31st March, and then I'm having 31st of March. Okay. So now the conversion has happened in this period on 31st of March. That means I'm having 2 categories of shares. The first one is 30,000 shares. The next one is 90,000 shares. Now, this 30,000 shares and 90,000 shares, this is going to look like this. 30,000 shares for this period. For this period, already converted. Already converted. That means what? 30,000 into 9 by 12 will form a part of my basic EPS. Will form a part of my basic EPS. Fair enough. Okay. For this period, did the conversion option be exercised? No. And therefore, here it is going to be potential. Here it is going to be potential. If it is potential here, then the interest expense is rupees 312.5. See, because it was a bond in the first 3 months, 312.5 would be deducted in arriving at the profit of 2 lakh rupees. In arriving at the profit of 2 lakh rupees. Since now we are considering the conversion, the interest for this 3,12,500 is automatically going to be your the interest for this is automatically going to be your addition or adjustment to the numerator. That is, you will add back 312.5. So I hope that part is correct. Coming to 90,000, ये तो convert ही नहीं हुआ. This is entirely potential. Potential for entire period. Okay. Potential for entire period. So that is the timeline. And now coming to the calculations. I told you, you will start with the diluted EPS from the place where you left the basic EPS. So basic EPS, you had taken 2 lakhs and 10 lakh 22,500. So these two will be there in the start. And then you will proceed with the workings. Okay. Any doubts now? Please tell me. Yes. Now just check the figures. I had noted it incorrectly. All clear. Srishti understood. Saksham understood. Aniket Jain samjha. Saksham, did you get to know 11 lakh 20? Shailendra Singh, period is followed. Soham, did you follow? Okay, now it's clear. Yeah, I think the presentation initially was not proper. But anyways, now it's clear. Means you are happy. I am happy. Okay. Okay. So this is your solution. So you can mark this question as important. It is important. Okay. Please ensure you revise it. Okay. So that takes care of diluted EPS in brief. Okay. जो कुछ भी करना था हम लोग कर चुके. We'll just write couple of points where you had left those 1.5 to 2 pages which I told you to leave. Just write down, give the heading diluted EPS. First point, 25,000 into 3 by 12. 1 second. Some query is there. Where is 25,000 into 3 by 12? Nowhere there is 25,000 into 3 by 12. 25,000 rupees of bonds get converted into 30,000 shares. And then we are having 30,000 into 3 by 12, not 25,000. Did I take 25,000 into 3 by 12 earlier? Shailendra, did you understand? Yes. Did you follow? Shailendra, just check 25,000 मैंने तो शायद लिखा नहीं था. I don't recollect now. Okay, so diluted EPS. This refers to the lowest possible EPS. This refers to the if I had written 25,000, please ignore that. If I had written 25,000, please ignore that. This is the correct ones. What I wrote earlier, I have to check now. Let me check. No, I have not written. I have the YouTube running in front of me. Nowhere have I written 25,000. I wrote 25,000 rupees into 5%. Yeah, मैंने देखा. I did not write 25 into 3 by 12. What I have written is rupees 25. This is the denomination of the bond. So this is that rupees 25,000. Okay. No, Soham. So that is what is new. We do not check only end of the year. See, the share could be potential at any point of time. The share could be a potential one at any point of time. So whatever period it is potential, we will have to give the impact for diluted EPS. Okay. So this refers to the lowest possible EPS in case in case holders of potential equity shares. This refers to the lowest possible EPS in case holders of potential equity shares exercise the conversion options. In case holders of potential equity shares exercise the conversion option. It is not necessary for exercising the options. It is not necessary for exercising of the options. Just the presence of such instruments in the capital structure will trigger the diluted EPS calculations. Second, examples of potential shares, potential equity shares include A. Convertible preference shares, debentures. B. Options, warrants. C. Contingent shares. We'll have a look at options and contingent shares later in the next class, maybe. Options, I'll try to finish it now, but contingent shares will move to the next session. Okay. the conversion or exercise is assumed to happen at the beginning of the earliest period or date of issue, whichever is later. Considered to exist or up to the date of conversion should reduce. Okay, conversion of potential equity shares should dilute that is reduce the EPS in case the potential conversion increases the EPS, comma, securities are considered anti-dilutive and should be ignored Okay, all right. We've already mentioned that we should not go into the question whether the holder of the instruments will convert or not. We are just concerned with the impact on conversion. So you have to assume that the conversion will take place. Do not think ye beneficial nahi hai, he will not convert. So therefore these instruments we will not consider. All that is not our area of questioning as far as Ind AS 33 is concerned. Ind AS 33, that is what we have written. It is not necessary for exercising of the options. Just the presence of such instruments in the capital structure will trigger the diluted EPS calculations. Okay. Have you guys noted this part down? Yes, these 3-4 points. Have you noted this? Yes. Are you able to relate with what are the questions we have done today? Are you able to relate with the questions we have done today? Yes. Are you kind of able to relate? Okay, fine. Then that's all that I need. So fifth one, adjustments for potential equity shares. Particulars, numerator, denominator. Denominator. Okay. So A, convertible preference shares. We will be adding preference dividend. Denominator, add shares issued. Exactly. We show the same basic EPS in solution of diluted EPS. Absolutely right. We have a question. I'll tell you how to show, what to show. Okay. So convertible preference shares. Convertible debentures. Oh, this Kaushiki is there. Okay. All right. Interest adjusted for tax. Okay. Issued. Ideally, convertible instruments compound financial instruments. Or preference dividend be the effective interest. You will study more in financial instruments. Okay. Would be the effective interest. Thus, potential conversion, comma, interest to be added back would be the effective interest. The adjustment for effective interest is to be done only if the market rate on similar non-convertible debentures, if such rate is not given, comma, just a minute, based on coupon rate itself. Okay. So there is something known as effective interest rate. So ideally we would be deducting that in the case of a compound financial instrument, but suppose the market rate is not given, which is the basis used in Ind AS 109. So if market rate is not given, we will not be considering that. We will not be considering. Is it okay? Yes. Yes. And then second point is we'll be writing that do not just consider interest and dividend, also consider the related impacts like managerial remuneration increase, etc. Okay. Not just may lead to increase in bonus to MD. This is based on the example. Okay. Okay. All right. So this is 1, 2, 3, 4, 5, 6. Incremental EPS. If asked, net increase in earnings conversion. Divided by shares issued on conversion. Shares issued on conversion. Okay. So that takes care of my diluted EPS. Noted down. Yes. Done. Done. Okay. Others comfortable? Is it getting a little boring? Honestly, batao. Is it getting a little boring? Not so interesting? No journal entries, nothing, only solving, solving, solving. Okay, so it's done. So आगे बढ़ते हैं. Let us proceed. We do the next part, that is options or warrants. Okay, so leave about 1 page to just write some small theory. Let us write small theory later on, but first let us understand how options work. Okay, so options is essentially a potential share. Yeah, so we have studied stock options. So what is a stock option? It is an option that is available with the employee to purchase the shares. So do I have potential shares in my capital structure? Yes. SBP reserve, what you are seeing, is nothing but potential equity shares. That is why when the tenure of the option expires, what we do, we close the SBP reserve and transfer it to retained earnings, so that no confusion. So options or warrants which are there, when I have given an option to exercise the shares at a particular price, we call that as the exercise price. So what is the shares issued at exercise price? And I get some money on the exercise. Now the money which I'm getting, if I had to issue those shares at a fair value, how many shares would be issued? So suppose I have given an option for 100 shares. So for 100 shares, say at 25, I am going to get 2,500 rupees potentially. Now 2,500 rupees divided by, let us assume that the market price is 150. So 2,500 pay, 1 second, 100 into 25. Each share is worth 25. You have given them 100 options. So potentially 2,500 is going to come to you. But suppose the market price is not 25. Market price is, let us say, 40. So that comes to 63 shares. So you got the consideration equivalent to 63 shares. But you have issued how many shares? You have issued 100 shares. So in effect, you have given 37 shares without consideration. And therefore, shares without consideration is what? This is nothing but bonus shares. Is it okay? Yes. So that is how you will proceed. And those are my potential shares which I am going to consider. Those are the potential shares which we will be considering for the purpose of diluted EPS. We will not consider the shares on which full value is going to be received. No. See, I am giving an option to buy 100 shares. 100 shares won't be potential because 100 shares ke samne they are definitely going to give me some consideration. Potential shares kya hai? Your existing shares are already converted to potential shares. Okay, there is no further adjustment that needs to be done. No transaction. Okay, just a preference share capital. They have paid the money already to us. Now it is just a board resolution that does the conversion. That's it. No further money is going to come. if money has to come in, वो potential नहीं होगा, because there is always an option that there is always an option that money may not come. So we are not going to consider those scenarios. We are going to consider plain scenarios जहाँ पे just because of passage of time the shares will come into existence. So for the options, if 100 rupees, if 100 shares were given whose what you can say exercise price is 25, I'm going to get 2500 rupees, but the market price is 40. So since I got 2500, 63 shares is what is the fair value of the consideration received. So therefore out of 100, 63 is at fair value. So 37 is the free element, and this 37 is what will be my potential shares. This 37 is what will be my potential. Sir 63, अरे पापा 63 के लिए तो you got the full consideration ना, तो वो potential कैसे हो गया? That becomes your actual shares whenever the options are exercised. The remaining 37, the free element, that is what becomes your that is what the free element becomes your number of shares for the purpose of diluted EPS, for the purpose of diluted EPS. Yes, it is kind of similar to the right shares. It is kind of similar to the right shares treatment. Okay. However, in the case of options, will my earnings be adjusted? Sir, kya matlab? Convertible debentures, I used to add back interest. Preference shares, I used to add back preference dividend. तो वैसे ही options के case में is anything going to be added back? Nothing. वो तो option है. Nothing extra is going to happen on account of exercising that option. Okay, so therefore there won't be any impact as far as the earnings are concerned. Earnings wahi ke wahi continue rahenge. Is it okay? Yes. Sometimes what happens, there may be multiple conversion ratios. Okay, if you convert in the next 1 year, you will get so many shares. In the next 2 years, so many. Next 3 years, 4 years. So this, in the case of multiple conversion ratios, what we are going to do is we are going to take that conversion ratio which maximizes the options to the holder, maximizes the number of potential shares, and minimizes the EPS as a whole. Okay, so with that background, let us just come to solve a couple of questions on options, and then we shall continue with the theory and some discussions. Okay, let us see how many questions we can do. Okay, so come to this question on slide number 55, question 3, page 80, page 11.80. Okay, so 1st January, the number of shares in issue is 10 lakhs. Profit for the year ended 31st December is rupees 1 lakh. Average fair value during the period is rupees 8. The company has in issue 2 lakh options to purchase equal ordinary shares with exercise price of 6. Calculate the diluted EPS for the period. Basic पूछा नहीं है, but it's always better to write because we should know whether the diluted EPS is actually dilutive. Okay. So basic EPS is equal to 2 lakhs, not 2 lakhs, 1 lakh divided by 10 lakh shares. So this is 10 paise, 0.1 per share. Okay, 0.1 per share. Okay. Now we calculate the free element in options. Free element in options. How do we calculate that? Well, see, the company has 2 lakh options in issue. 2 lakh options in issue. Out of this, for 2 lakh options, they will exercise and give 6 rupees. They will exercise and give 6 rupees. So I'm going to get 12 lakhs. I'm going to get 12 lakhs. But at the fair value of rupees 8, at the fair value of rupees 8, what will be the actual consideration at what will be the actual number of shares based on the average fair value? Well, 12 lakhs divided by 8. So that is going to be 1,50,000. तो आपने तो 2 लाख शेयर दिए, बट पैसे कितने शेयर का आया? पैसा आया 1,50,000 शेयर्स का. So the remaining is your free element. Okay. So therefore, if I talk about diluted EPS, this is my free element, 50,000 shares. This is free element. Is it okay? Yes. So therefore, this 50,000 represents the potential shares present in my capital structure. Therefore, diluted EPS. Rupees 1 lakh. Divided by 10 lakh. What I told you, starting point is basic plus options के वजह से no change in the earnings, and number of free shares is 50,000 shares. So 1 lakh divided by 10 lakh 50,000. So that comes to rupees 0.095 per share. Is it okay? Did you understand? So this is how you are going to get your free element in the options, which becomes the basis for your diluted EPS workings. Samjha? Kaushiki, did you follow? Soham, Manini is clear. Kaushiki is clear. Soham, did you follow? Shailendra, Sandhya, Gauri, have we followed? Yes. All right. So this is clear. So we then move on to the next part. Okay. Come to this. At 31st December X7 and X8, the issued share capital of an entity consisted of 40 lakh ordinary shares of rupees 25 each. The entity has granted options and that give holders the right to subscribe for ordinary shares between 20Y6 and 20Y9 at rupees at rupees 70 per share. Options outstanding at 31st December X7, X8, 6 lakh 30. No grants, exercises or lapse of options. Profit after tax attributable to ordinary equity holders for the 3 years ended 31st December X7 and X8 amounted to 5 and 6 lakhs respectively, wholly relating to continuing operations. Average market price year ended 31st December X7 and X8. Calculate basic and diluted EPS. Okay. All right. I want you to try this right now. Try it year wise, you will get the answer. 31st December X7 and 31st December X8. Try it out now that you know how to solve it. Come on, try it out. Okay. 2 years are there. So we will have to do the working accordingly. Basic EPS 5 lakhs and here it is 6 lakhs. Five lakhs, 6 lakhs, profit after tax divided by should share capital 40 lakh shares. Five by 40.125 per share, and this is 0.15. 0.15 per share. Okay, so ये हो गया basic free element in options. Six lakh 30,000 options were given. Exercise price is 70. Year ending 31st March 20x7, the fair value is rupees 120. Okay. Whereas in this case, minus 6 lakh 30 minus into rupees 70 by 160. Okay, so this takes care of the workings. So two 60 to 500. Next one, 6,30,000 divided by 160 into 70. 6,30,000, 354, 375. 354, 375. Diluted EPS. Starting point is basic EPS. 40 lakh. Acha, because of options, will there be any change in the earnings? Answer is no. So no change in the earnings. What will be my free element in the options in the first case? 260 to 500. And in the second case, it is 354, 375. By 4, 660 to 500. 40 lakhs. .0 per share. And then hmm, 38 per share. Always compare diluted. Is it lower? Yes. Is it lower? Yes. So this becomes diluted. Manini, check your answer. You have probably typed it reverse. That's it. Otherwise, I'm okay. Basic Kaushikis is just check the basic is fine. Diluted, just check your workings. Okay. Done. Done. Shall we proceed further? Shall we proceed further? Kaushiki, Srishti, is it clear? Shailendra, Saksham Lohia, Soham, clear? Done. Okay, fine. We then move on to the next one. So this question is done. Okay. All right. Fine. Okay. Okay. Done. Good. Let us proceed. Okay. So coming to the last question of the day. Illustration 9, you can mark this as important. It has come, it has been put in the recent syllabus that is there. Okay. All right. So now let us start. At 30th June 20x1, the issued share capital of an entity consisted of 15 lakh ordinary shares of rupee 1 stock of rupee 1 each. On 1st October 20x1, the entity issued 12 lakh 50,000 of 8% convertible loan stock for cash at par. Each 100 rupees nominal value, that is face value of the loan stock, may be converted at any time during the years ended 20x6 to 20x9 into the number of ordinary shares as set out below. So for each loan stock of 100 rupees, you can get 135, 130, 125, 120. So this is the maximum, the ratio that maximizes the what you can say, the conversion, the ratio that maximizes the conversion. So we will be doing the solution based on the first ratio itself. Okay. So we are selecting that ratio. Which is maximizing the conversions. Okay. If the loan stocks are not converted by 20x9, they would be redeemed at par. This illustration assumes that the written equity conversion option is accounted for as a derivative liability. Okay. And marked to market through profit or loss. Okay. The change in the options fair value reported in X2 and X3 amounted to losses of 2,500 and 2,650 respectively. It is assumed that there are no tax consequences arising from these losses. The profit before interest, fair value movements and taxation for the year ended 30th June X2 and X3 amounted to 8,25,000 and 8,95,000 respectively and relate wholly to continuing orders. Relate wholly to continuing operations. The rate of tax for both the periods is 33%. Calculate basic and diluted EPS. Okay. So couple of points in this relates to financial instruments. So I will just briefly tell you what is being done here. So that should kind of streamline your understanding. The main thing is this one. Okay, the main thing where you are having what you can say, the financial instruments applicability is this para. So what you are having, well, it is accounted for as a derivative liability. So it is a financial liability. Since it is accounted as a financial liability, they are fair valuing it through P&L, which is what they have said when they are saying that it is marked to market through profit or loss. That means what? They are using fair value through profit and loss as the principle for valuation. The change in the options fair value amounted to losses of 2,500 and 2,650 respectively. Where will this movement go? Will it go in the P&L or the OCI? Sir, this movement will go in the P&L because they've taken it as a financial liability, which is correct. Okay, which is correct. So the previous period's losses is 2,500 and 2,650 respectively. The profit before interest, fair value movements and tax. So this is the profit before all this. From here we will be deducting interest, tax and fair value movements. From here we will be deducting that. Okay. So it relates wholly, the profit relates wholly to the continuing operations. Rate of tax for both the periods is 33%. So calculate basic and diluted EPS. Okay. So with this background, let us start solving. Okay. It should not take much time. Okay. Should not take much time. Calculation of basic EPS. Always start with the basic EPS because basic EPS is the starting point for diluted EPS. So we start with basic. So you are having this is question 9, illustration 9. Calculation of basic EPS. Okay. So particulars. Year ending 30th June. X2. It's 30th June, no? Yes. Year ending 30th June 20X3. Okay. So now profit before interest, tax and fair value adjustments. How much is it given? 8,25,000, 8,95,000 respectively. 825, 895 less interest. Okay. So how do I calculate the interest? On 1st October, that means after 3 months, July, August, September, after 3 months, entity issued 12,50,000 of 8% convertible loan stock. So this is going to be 12,50,000, 8%, 9 by 12. So that comes to 75,000. Next one is for the full year. So 12,50,000 into 8%. So this is going to be 1 lakh. This is going to be 1 lakh. So this comes to 825 minus 75. That is 7,50,000. And this is 7,95,000. Okay, so this is profit before tax and fair value adjustments. Okay, now if you look at the question, the change in the options fair value is given. It is assumed that there are no tax consequences. That means it is neither tax deductible. There is absolutely no tax impact. So we will first give the tax impact on 7,50,000 and then we will give the impact for the fair value loss. So profit therefore, or what I can do is less tax at the rate of 33%. So that gives you how much? 7,50,000 into 33%. 2,47,500. And this is 262,350. So this is going to be 502,500 and 532,650. What is this? This is profit before fair value adjustments less fair value adjustments, which is how much? Well, my fair value adjustments, that is your loss essentially, is 2,650 for X3 and 2,500 for X2. 2,500, 2,650. So we are left with 5 lakhs and 5,30,000. Net profit attributable to equity shareholders divided by weighted average number. How many shares at 30th June? It is having 15 lakh shares. So this is 0.33 per share and this is 0.3533 per share. This is your basic EPS. This is your basic EPS. Done? Have you understood basic EPS so far? Basic EPS समझा अपने को? Yes or no? Did we follow basic EPS? Done. Okay, so Kaushiki confirmed, Aniket Jain, Soham, Srishti, and yep. What about Manini? Is it? Yes, she has also confirmed. Shailendra, Aniket Jain today. Sumit is not there. और 2-3 लोग होते थे. Sandhya Gauri, is it clear? Venkat Subramanian, one was there. Gauri Shankar Rao, I don't think these are there. Sir, fair value adjustments will always be after tax and interest only in this case, because it is not having any tax impact. Only in this case they have specifically given in the question, no tax consequences. Generally they will have, but here they have said it won't have. So that is why we follow the question. Okay, so that depends. Okay, that depends. All right, so that takes care of basic EPS. Moving to diluted EPS. Diluted EPS. Okay, so there are multiple conversion ratios, so we are taking the ones where the conversion is maximized. Okay, that is 135, and we are also given that there is no tax impact, so that is going to be considered accordingly. Okay, so therefore year ending 30th June. 30th June 20x2. Starting point is basic EPS. So 5 lakhs divided by 15 lakh shares plus. Acha. Now what is happening? potential shares are there. So because of potential shares, we will add back whatever is the impact. So first thing that we are going to add back is this interest of 75,000. Okay, so add 75,000. Acha, but 75,000 pe to tax impact is there, na? So we will be adding it post tax. Plus, what is the next one? Well, options are getting converted, so mark to market also will be added back. So plus 2,500 plus 2,500, and then you are having potential shares. How many shares? How many options? 135 ordinary shares issued 12,50,000. So 12,50,000 divided by 100. So that gives you how much? 12,50,000 divided by 100. 12,500 into 135. Into 135. So that gives you 16,87,500 shares. 16,87,500 shares. So we will be adding that. Okay, that is the shares which will be added on account of exercise of the option. 16,87,500 shares. The loan was given on 1st October. So obviously potential shares also are coming into existence from 1st October, and that is why we will take 9/12 as loan notes issued on 1st October 20x1. Otherwise we take it for the full year, but here since the loan notes only came into existence in October, we are going to have to do this working. So that comes to how much? 75,000 into 0.67 plus 2,500 plus 5 lakhs. So 552,750 divided by 16,87,500 into 9/12 plus 15 lakhs. 27,65,625 shares divided by 0.20. Immediately you compare this with the basic. Is it lower? Yes. So then you can write into bracket diluted. Then you can write into bracket diluted. Okay. Year ending 30th June 20x3. 5,30,000 divided by how many shares? 15 lakh shares. This is the starting point for diluted, plus 1 lakh is your finance cost. One minus 0.33 plus 2650 fair value adjustments. Next, plus 15 lakhs plus now 16,87,500 into 12/12, because here it is there for the entire period. Here it is there for the entire period. So 5,30,000 plus 67,000 plus 2650. 5,99,650 divided by 16,87,500 plus 15 lakhs. 31,87,500. 0.19. Compare it immediately. 0.19, 0.35. Is it lower? Yes. So this becomes my diluted EPS. Have you guys understood diluted EPS? Yes. Have you understood diluted EPS? Understood? Yes, clear. Okay. Kaushiki, for me to explain the loss on fair value adjustments, we will have to visit financial instruments. So as of now, I think it's better that you park it for the financial instruments class, because if I have to discuss this, it's a whole long discussion for which we do not have the time also, and that is not necessary right now also. Okay, so this loss is basically, see, all options in the nature of a liability have to be fair valued. So the fair value movement is what we are recording in the profit and loss. That is the simplest way I can conclude it for you. Okay, see, essentially these options, let me just briefly put it up for you. These options, it has issued 12,50,000 worth of loan stock to be converted into shares, So ideally, when loan is getting converted to shares, typically, if nothing was given, just a fixed, jitna loan hai utne ka share milega. If it is a fixed for fixed conversion, usko hum log bolte hain fixed for fixed. If it is a fixed for fixed conversion, it would be known as equity. But in this case, what is happening is the conversion ratios are different. And because the conversion ratios are different, it is varying on account of time. See, saal badalte your ratios are varying. That is why in this case it is regarded as a financial liability. Ideally, if the conversion ratios are fixed, it would be equity. If it is variable, it becomes a liability. And since it becomes a liability, we are following fair value through P&L principles. That means we have to fair value this liability at each reporting date, and whatever be the changes in the fair value, that change we are recording it in the P&L. So this 2.5 and 2650 represents that movement in fair value. Okay, so that takes care of this question. You can just mention in the notes, to the question, you can obviously write a couple of things. The first one is, since there are multiple conversion ratios, this last part, since there are multiple conversion ratios, comma, we consider that ratio which maximizes the dilution. Hence, potential equity shares is equal to 135 into 12,500 is equal to 1687,500 with effect from 1st October 20x1. First point. Tax impact on fair value adjustment are ignored as per the question. Okay, so these are the two things which we can write. Okay, so that takes care of diluted EPS. Tomorrow, diluted EPS is done, options and warrants are done. Tomorrow, we'll be doing a small question on financial instruments applicability. Then the major part we will be spending in discussing, not tomorrow, that is on Thursday. The major part we'll spend in discussing the contingent shares. Okay, contingent shares. So that is very important and interesting as well. So we will be discussing that. And yeah, I think you are on track to complete the standard in totality. Okay, so that takes care. See you guys on Thursday. Thank you, everyone. I'll try to keep the session a little lively in the next one. Okay, it's been a lot of problem solving. Can't help, the standard is like that. Okay, so we'll see you on Thursday. Okay, any doubts or anything you've not understood? Any doubts or anything you have not understood? All clear? Soham, Manini, Srishti, all clear? Kaushiki, Shailendra, Sumit, Aniket, all clear, guys, girls, boys and girls? Okay, good. So see you guys on Thursday. Thank you, everyone. Take care. Stay safe. Okay. All right.